Hi everyone. For those of you who are new to the channel, I'm Teresa Perrin, and today I want to discuss with you what a reverse split is, the pros and the cons, and why they happen. So let's get into it. Please remember, nothing I say is financial advice. Please like and subscribe if you haven't already. A reverse split is the opposite of a stock split. When a company like Apple does a stock split, they're essentially taking their shares that are, somewhat expensive. Let's say Apple's at $150 and they're going to do a 3-for-1 split. That means they're going to make it so that for every share you own, you'll now own 3 shares at $50 each instead of 1 share at $150. However, a reverse split is the opposite of that. They're taking shares that are generally very cheaply priced and combining them to make them more expensive. So let's say that you own 10 shares of AVCT, or let's say you own 100 shares of AVCT at a price of 20 cents each. And the company announces that they're going to do a 10-for-1 reverse, a 1-for-10 reverse split. What that means is for every 10 shares that you own of AVCT at 25 cents, when the reverse split happens, you will own 1 share at $2.50. And I'm sorry, I think I may have changed the price along the way in there, but you get the point. I think I gave an example of 20 cents. So if you had 100 shares at 20 cents and they're going to reverse it and do, that 1-for-10 split, then what that equivalates to is $2 per share, and you'll now own 10 shares at $2 versus 100 shares at 20 cents. So as you can see, it still has the same value. You just own less shares. The definition that is given is a reverse stock split consolidates the number of existing shares of a stock held by shareholders into fewer shares. A reverse stock split does not directly impact a company's value, only its stock price. It can signal a company in distress since it raises the value of otherwise low price shares. But guys, this is not always the case, and we will get into that more in just a second. For those of you who are visual learners, here's an easy example. So if you have 2 shares of stock ABC at $2 each, and they do a reverse split for a 2-for-1, you would own 1 share of ABC stock at $4. Hope that helps clarify if there was any confusion. Now, a company will perform a reverse stock split to boost its stock price by decreasing the number of shares outstanding. So the benefit of this, guys, especially in heavily shorted stocks, is that they're now decreasing the float as well. So the benefit of it is there's a lot less shares available. Should the company suddenly get a run, then those shorts that are going to have to go back and cover, yes, they're going to have to cover less shares because it's a higher price and it's the same conversion, but also shares may be harder to find because they may be eaten up faster in the market. And we'll get into that a little bit more in a minute. But a reverse stock split has no inherent effect on the company's value, with market capitalization remaining the same after it's executed. And guys, the reason for that is because nothing's changed price-wise, at least not on paper. So, meaning, if the company has 100,000 shares and their market in each of those shares is $1, then that market cap would be $100,000, right? Now, this is just giving you easy math examples. Obviously, no company on the stock exchange has that little value. But if they go and they do a reverse split and they make a 10-for-1, so now they make 10,000 shares available at $10 each. At the end of the day, their market cap is still $100,000. This path is usually pursued to prevent a stock from being delisted or to improve a company's image and visibility. All right, guys, so there is a NASDAQ rule that your stock needs to be trading above $1 in order to maintain its listing on the NASDAQ. If it falls below $1 in a 30-day period, I think it has to be below for 10 of those 30 days, but I could be mistaken on that. However, I believe that's how it works. So if it falls below for 10 days, they're going to get a letter from the NASDAQ, a letter of delisting. And that's often what you're seeing in a lot of these very inexpensive priced stocks, because they have to maintain a certain price and a certain market cap. But again, when the price is lowered, it lowers their market cap as well. So they can have two problems on their hands, right? So a lot of times they will do what they can, with trying to maintain that price or get it back above $1. However, sometimes when you're trapped with heavy shorts in your stock, like Mullen, for example, right now, Mullen, I am sure, has received a letter of delisting. BBIG, I'm sure, has received a notice letter of delisting because their stock is below $1 and has been for over 10 consecutive days, right? So when they get this letter, they have two choices. One, they can do something to get more people interested in buying to maintain that stock above $1 for 10 consecutive days, guys. And then they'll be in NASDAQ listing requirements again. But ultimately, if the stock price falls back down, it can happen. And they will get another letter of delisting. And it tends to be a vicious cycle for some stocks, unfortunately. So guys, the best thing that these companies can do in this scenario is to do a reverse split. And I mean, sometimes it really stinks as an investor, especially let's say you don't have a huge account, right? But to you, 100 shares is a lot of shares, right? Now, let's use BBIG for an example. Let's say you bought BBIG at $7 per share, and now it's trading at 90 cents a share. And guys, that may be up or down a few cents. I'm just using an example. So you've already lost a ton of money, right? You had 100 shares at $7. That was $700. Now you have still that same 100 shares, but at 90 cents. So it's $90. You've lost $610 already. Now the company announces that they're going to do a reverse split. Let's say they do a 2-for-1 reverse split to bring the price to $1.80. Guys, there's a big problem. BBIG is heavily shorted. If they do that and the price goes to $1.80, what do you think the shorts are going to try to do? They're going to short it down harder. So now your 50 shares that are at what, because it's split, or they did a reverse split, 2-for-1. So now you have 50 shares at $1.80, which is still $90. But now the shorts managed to bring it down more, right? And they get it under $1 again. For a significant number of days, they get another letter of delisting. Now the company's forced to do another stock split. And it's a vicious cycle that is tough to get out of. So as bad as it stinks, in my opinion, it is better for the company to try to do a 10-for-1 or 20-for-1 reverse split and get that price a lot higher to make it more difficult for the shorts to continue their actions. And a lot of times, no matter what type of split they do, the price will dip, but it's only temporary. Then it starts to go up, and we'll get into that in a few minutes. But again, this is usually done to prevent a stock from being delisted or to improve the company's image and visibility. Now, guys, that's a benefit of it. If they do the latter that I just talked about, and let's use BBIG for the example again. Let's say they did a 10-for-1, or let's say they did a 20-for-1, and the stock now is trading at $18. That makes that company a lot more attractive and investable to a lot of investors that it otherwise wasn't. Now, during a reverse stock split, the company cancels its current outstanding stock and distributes new shares to its shareholders in proportion to the number of shares they owned before the reverse split. So, for an example, in a 10-for-1 reverse split, shareholders receive 1 share of the new stock for every 10 shares that they owned. So in other words, the shareholder who had 1,000 shares would end up with 100 shares after the reverse stock split was complete. But again, guys, it doesn't change the value at the time of the split. It's the same. However, it can as a result, and we'll get into that in a minute as well. But I do have, I want to find the right one for you. This one. Hang on one second while I just want to show you that there's a process to this, and that a lot of people that spread FUD give you the fear that it's going to happen like that second to get you to sell. But this is what the process of a reverse split is. The company management proposes a reverse stock split to the company's board of directors. The board of directors votes in favor of the reverse split, which is subject to the approval of shareholders through a vote. The company publicly announces the split, as well as detailed information such as the split ratio and the date of the split. On the split date, the company cancels its current outstanding shares and distributes new shares to its existing shareholders in proportion to the amount of shares owned prior to the split. So guys, there's a process, and they left out in this because I took this example from, I think it was an article in Seeking Alpha, and they left out the fact that first the company gets a letter of delisting, if that's the reason that they're doing the stock split. So that's very important, and that you can see under the filings, which is why it's important, guys, that you learn how to read filings for companies that you're invested in. Now, to prevent being delisted in a stock exchange is one reason why a company will do a reverse split. And like I said earlier, if the stock price falls below $1, it's at risk of being delisted from the stock exchange. They have to have a minimum share price of $1 in order to be listed on the NASDAQ exchange. Being listed on a major exchange is important for attracting equity investors, and in some cases, the only way to prevent removal is to increase share prices by engaging in a reverse stock split. And guys, this is the most common reason that you will see reverse stock splits done. Another reason that they can be done is to boost the company's image if the stock price has dropped dramatically. If the stock's trading in the single digits, it's likely to be viewed as a risky investment. Remember that the bigwigs on Wall Street generally don't like stocks that are anything under $5. They consider them penny stocks. So if it's trading in the single digits, it's likely to be viewed as risky, particularly if the price is near $1 or considered a penny stock by investors. And guys, I just told you what they consider a penny stock. There is a negative stigma attached to penny stocks traded only over the counter. So what would happen to well, let me finish this and I'll get into that. Which over the counter, guys, is OTC stocks. And sometimes the quickest method to escape this association and protect a company's brand image is to engineer a reverse stock split. Now, guys, let's say that they propose a reverse stock split, or let's use EVFM for an example. If you guys are familiar with EVFM, I actually love this company, and I think they have a great product. I think the management needs to figure stuff out, though, because they never should have allowed their stock to be delisted from the NASDAQ. What happened was they got the first letter and they did a reverse split. They received the second letter after that because the share price fell below $1 again, guys, for the number of days that the NASDAQ will send out a warning for, which I believe is 10 in a 30-day period, but I could be wrong. So they get that letter again, and instead of proposing another stock split, guys, they got 9 of the 10 days above $1. And then those greedy little people on Wall Street sunk their stock to close below $1 so that they couldn't maintain that uplisting. And since they didn't apply to do the reverse stock split in time, now they're being traded on the OTC market. And guys, when your stock goes from NASDAQ to OTC, it's going to dive in price. And then you have to start the process all over again should you want to uplist in the future. It's a horrible, horrible thing to have happen. And that was management's own fault for not properly executing. However, I think that they felt targeted, and I can understand their decision because I think they're hoping to just prove themselves in the OTC, and maybe it'll be a better fit for the time being because, guys, they were heavily, heavily shorted. And this is what shorts, they short and distort. They try to destroy these companies because it's in their best interest to bankrupt the company, because then guess what happens? They don't have to pay taxes on the money that they shorted, that they got from that. They don't have to pay it back, and they don't have to pay taxes. Now, since they're trading on the OTC, they still have to come up with those shares. But if they can manage to get them off the stock market altogether or to bankrupt the company, then they'll never pay that back, which is sickening. It's really, really sickening, some of the things that happen, especially when you have a company like EVFM that has a great product. But guys, this market there's nothing nice about it. Let's just put it that way. And it's not fair on any aspect of the level. Let me just say, after everything I've seen and learned, if I had a company, I would never, ever go public. But that's me. There's obviously a lot of benefits to going public and a good way to raise funds. But when you get in with some of these devils, that's basically the way I see them, that want to destroy your company, you will get screwed. And this is one of the ways that they do it. All right, guys. So the other benefit to a reverse stock split is it can draw more attention from analysts and influential investors. High-priced stocks attract more attention from market analysts, and a favorable view from analysts is excellent marketing for the company. They are also more likely to pop up on the radars of big institutional investors and mutual funds, many of which have policies against taking positions in a stock whose price is below a minimum value. And that's exactly what I said. A lot of these have rules where if the stock's trading below $5 or even below $10, they won't touch it, guys. So, it's in their best interest to do a reverse stock split to a higher amount, in my opinion. Yeah, it stinks for the shareholders that now have less shares, but overall, it will make the company more investable. So even though you have less shares, guys, if the share price goes up, then it's better for you. I mean, it's a catch-22, unfortunately. And here we go. Reverse stock splits can carry a negative connotation because, as previously stated, a company is more likely to undergo a reverse stock split if its share price has fallen so low that it is in danger of being delisted. Consequently, investors might believe the company is struggling and view the reverse split as nothing more than an accounting gimmick. And guys, it's not an accounting gimmick. It's that they need to uphold their NASDAQ listing. And that's the only way that they can do it. And honestly, you can't blame them. They have to do that. Now, the disadvantages of a reverse stock split. Loss of liquidity. Since a reverse split reduces the number of shares available in the market, the split can harm liquidity, which can then negatively impact the share price. Now, guys, the loss of liquidity, yes, it can do that, but it can also increase the share price, especially in heavily shorted stocks, should something happen to create positive media attention to that stock, because it's supply and demand. Negative perception. Although a reverse stock split can help to boost a stock's image among investors, reverse splits are often received as a negative sign that the company is struggling. Guys, and that is very true. And let me give you my personal perception and what I've seen in reverse stock splits. So very commonly when a company does a reverse stock split, let's take Pets, for example. Pets recently was trading, well, not recently, several months ago was trading very, very low, below 50 cents, like 40 cents, maybe even shorted lower, guys, before this reverse stock split. They did a reverse stock split, which hence increased the price. Well, initially, shorts attacked it even more, drove the price further down. I forget what the split was for the ratio, but let's just say, I think maybe 20-1, okay? And let's say it was trading at, actually it was probably less than that. Let's say it was 10-1 and it was trading at 30 cents. That 10-1 would have made the price $3, right? And then let's say after that happened, the price dropped to under $2, okay? And this is pretty much what happened. I may be off with the calculations, but it's something like this, right? But then all of a sudden, people start getting attention on this stock again. And now, guys, the stock has gone up as high as $5. Yesterday, unfortunately, with the low volume, it also has a very low float now. But shorts were able to take advantage of the low volume to drive the price down. But I think next week in pets, you're going to see it spike back up. And guys, when they go to cover this, this now makes that stock have an all-time high of well over $100. So there's a possibility when you see stocks that do this that now have very low floats for them to have massive squeezes in the future. So it's something that investors use, or, you know, a lot of retail traders as well, I certainly do, to target, you know, a reverse split and to buy up shares after they feel it's hit that low point and they start to see some covering going on, because it can create a surge in price. But the reason why I caution people on companies that when they decide to do a reverse split, the price still is under $2, guys, is dangerous, because they will short it harder initially before they start to cover. Look at Excella. That's a perfect example. They just did a reverse stock split and the stock's under $1 again, guys. These shorts are ruthless. And of course, they want to pay back. Right now, if they were to pay it back, they're paying like literally, I think, a penny or less per share. They shorted that all the way down from several dollars to a penny, yet they're still not happy, guys. So be careful with reverse stock splits is all I'm saying. And, you know, sometimes they're a good thing, but other times, or initially, when you hear that, it tends not to be so good in the beginning. So you may want to think about that as an exit point for a stock that decides to do a reverse stock split, but they announce it. They give you a date. Sometimes if you're not following closely, you can get taken off guard, but generally you'll see a notice go out, and you'll kind of know too from the NASDAQ listing requirement when they're getting close to their deadline, because of course they're not going to want to wait to the exact second, guys, but they are going to want to wait pretty close, because hopefully they can get that stock price up first before they have to do this. This is like a last resort, unless they want to drive it exceptionally higher to get that institutional investor back in. But I hope this helps, and I hope that you understand. If you still have questions, please leave them in the comments below. If I see enough of something, I'll try to make an update to answer them. All right, thanks, guys. Have a great rest of your day.